Preparing for an agency lending interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is agency lending, and how does it differ from principal lending? Agency lending is a securities lending model where an agent bank lends assets owned by beneficial owners to approved borrowers. The agent facilitates loans, manages collateral, billing, recalls, and reporting, but the securities remain the client's property. In principal lending, the intermediary typically borrows securities and lends them onward for its own balance sheet economics. In agency lending, the client earns most revenue, and the agent earns a fee split for operational and risk management. While answering, focus on the agency role, beneficial owner versus borrower relationship, ownership of securities, revenue sharing, and how agency lending differs from principal or conduit securities lending models. Question 2. Walk me through the life cycle of a securities loan in an agency lending program. When a borrower needs a security, usually to cover a short sale or settlement need, the agent checks availability, eligibility, utilization, and borrower limits. If terms work, the loan is booked against collateral, usually cash or high-quality securities. Daily, the position is marked to market. Collateral is adjusted. Fees accrue, and corporate actions are monitored. The loan ends when the borrower returns securities, or the beneficial owner recalls them for sale, voting, or investment reasons. Make sure to cover trade initiation, availability checks, collateral receipt, loan booking, daily mark-to-market, income accrual, recalls, returns, and why operational control is central throughout the loan lifecycle. Question 3. How does an agency lending program generate revenue? The economics depend on whether collateral is cash or non-cash. With cash collateral, the borrower receives a rebate rate, the cash is reinvested, and lending revenue is the spread after investment returns and costs. With non-cash collateral, the borrower pays a lending fee directly. Hard-to-borrow specials command higher fees, while general collateral names earn little. A beneficial owner and agent then share net revenue based on the agreed split. In your answer, talk about cash collateral rebates, non-cash lending fees, intrinsic value, general collateral versus specials, reinvestment spread, borrower demand, and the revenue split between client and agent. Question 4. What types of collateral are used in agency lending, and why are haircuts applied? Collateral is the lender's primary protection if a borrower fails to return securities. I would discuss acceptable collateral types: cash, government bonds, equities, letters of credit, depending on the program. The collateral value must exceed loan value through a margin, for example, 102% for domestic equities and 105% for cross-currency loans. Haircuts reflect market, liquidity, FX, and settlement risk. Strong daily mark-to-market controls keep exposure aligned as prices move. Be sure to mention eligible collateral types, over-collateralization, haircuts, daily mark-to-market, cross-currency risk, liquidity quality, and how collateral protects the lender if the borrower defaults. Question 5. What are the main risks in agency lending, and how would you control them? I would frame the risks in layers. Borrower default risk is the headline risk, especially if collateral is insufficient or illiquid. Reinvestment risk matters when cash collateral is invested in instruments that lose value or liquidity. Operational risk includes failed settlements, incorrect recalls, corporate action errors, and bad data. Legal risk sits in enforceability of agreements and closeout rights. A strong program controls these through borrower limits, collateral policies, indemnification, and daily monitoring. While answering, focus on borrower default, collateral shortfall, cash reinvestment, operational errors, legal enforceability, corporate action risk, and the controls agents use to keep lending risk within mandate. Question 6. What is borrower default indemnification in agency lending? Indemnification is a promise by the agent lender to make the beneficial owner whole if an approved borrower defaults, and collateral is insufficient to repurchase the loaned securities. It usually does not cover every loss, such as reinvestment losses or client-directed exceptions. In interviews, I'd stress that indemnification is valuable, but conditional. The agent still needs robust borrower approval, collateral control, legal documentation, and capital discipline, because indemnity creates real contingent exposure. Make sure to cover what indemnification protects, what it usually excludes, why it matters to beneficial owners, and how it changes the agent-lender's risk and capital discipline. Question 7. What factors should a beneficial owner consider before joining an agency lending program? Before a client lends, I would ask what they are trying to optimize: incremental return, liquidity, governance, or risk limits. Key decisions include which securities are lendable, eligible borrowers, collateral types, minimum spreads, concentration limits, reinvestment guidelines, and voting recall rules. A pension fund may accept conservative revenue, while a more return-focused owner may lend harder to borrow names. The best programs match lending activity to the owner's fiduciary duties and liquidity needs. In your answer, talk about client objectives, lendable assets, eligible borrowers, collateral guidelines, minimum returns, liquidity needs, proxy voting, ESG constraints, and how program settings reflect fiduciary responsibility. Question 8. How are dividends, proxy voting, and corporate actions handled when securities are on loan? Corporate actions are critical because the economic owner and the record holder can differ while securities are on loan. The agent must track dividends, manufactured payments, stock splits, rights issues, and voting dates. If the beneficial owner wants to vote, securities generally must be recalled before the record date. For dividends, the borrower compensates the lender through a manufactured dividend. Good controls prevent income leakage, tax surprises, and client dissatisfaction. Be sure to mention manufactured dividends, record dates, proxy voting recalls, tax sensitivity, corporate action processing, and why inaccurate handling can create client, regulatory, and reconciliation issues. Question 9. What happens if a beneficial owner sells securities that are currently out on loan? If a portfolio manager sells a position that is out on loan, the agent sends a recall to the borrower requesting return by the required settlement date. Most recalls are routine, but risk appears if the borrower cannot source the securities. The agent then escalates, monitors buy-in exposure, and may restrict future borrowing. The key is speed. Recall timing affects settlement performance, client liquidity, and the credibility of the lending program. While answering, focus on why recalls happen, communication to borrowers, settlement deadlines, escalation for non-return securities, buy-in exposure, and the link between recall performance and client liquidity. Question 10. Explain cash collateral reinvestment and the risks it creates. Cash collateral creates a second investment decision, not just collateral protection. The agent or reinvestment manager invests the cash under guidelines, often in short-term money market instruments. Revenue comes from earning more on reinvested cash than the rebate paid to the borrower. The danger is maturity mismatch, credit losses, or liquidity freezes, which can hurt the lender even if the borrower performs. That is why conservative duration, liquidity, and credit limits are essential. Make sure to cover rebate economics, reinvestment spread, permitted instruments, maturity and liquidity mismatch, credit risk, stress periods, and why cash collateral can create losses beyond borrower default. Question 11. What is the difference between general collateral and specials in securities lending? General collateral securities are easy to borrow and widely available, so fees are low and balances are volume-driven. Specials are scarce securities with strong borrower demand, often because of short interest, index events, corporate actions, or settlement pressure. A special can earn materially higher fees, but availability may change quickly. In an interview, I'd connect this to utilization, lendable supply, borrower demand, and pricing discipline, rather than just saying, hard to borrow. In your answer, compare supply, demand, fee levels, utilization, short interest, scarcity, corporate events, and why specials require active pricing and monitoring, rather than passive balance gathering. Question 12. Which key metrics would you monitor to assess an agency lending program? I would monitor both revenue and risk metrics. On revenue, utilization, lendable assets, fees, spreads, specials contribution, and revenue split show commercial performance. On risk, I'd track collateralization, mark-to-market breaks, borrower concentration, fails, recalls, aging loans, indemnified exposure, and guideline exceptions. Trend analysis matters more than one day's number. For example, rising revenue with worsening collateral disputes may signal the program is taking unattractive operational risk. Be sure to mention both commercial and risk metrics, including utilization, lendable base, fee spreads, specials revenue, collateralization, borrower exposure, fails, recalls, exceptions, and trend-based monitoring. Question 13. What legal documentation supports agencies' securities lending transactions? The legal base is usually a securities lending agreement, such as a GMSLA or MSLA, supported by schedules, collateral terms, and operating procedures. These documents define eligible collateral, margin, recall rights, default events, closeout netting, manufactured payments, and representations. Without clear terms, a borrower default becomes much harder to resolve. I would emphasize that agency lending is operationally active, but legally document-driven, from onboarding through termination. While answering, focus on the role of MSLA or GMSLA documentation, collateral schedules, default rights, closeout netting, manufactured payments, recalls, and enforceability across jurisdictions globally. Question 14. A borrower defaults and collateral covers only 98% of the loan value. What would you do? First, I would freeze further activity with that borrower and follow the default process in the lending agreement. Next, value the shortfall, liquidate or apply collateral according to legal rights, and purchase replacement securities if needed. I would notify the beneficial owner and internal risk teams quickly and check whether indemnification applies. Then I'd perform a post-mortem on collateral margining, borrower limits, and escalation to prevent repeat losses. Make sure to cover immediate default escalation, exposure calculation, collateral liquidation, replacement purchase, client notification, indemnification assessment, root cause review, and tightening controls after the incident. Question 15. How do regulations and market structure changes affect agency lending? Regulation affects both demand and program design. Capital rules can make borrowers more selective about balance sheet, so trades with high-quality collateral and efficient terms are preferred. SFTR and similar rules increase transparency through transaction reporting. CSDR and settlement discipline raise the cost of fails. I would also mention liquidity rules and indemnification capital charges for agents. A strong candidate links regulation to pricing, borrower appetite, operational controls, and client returns. In your answer, talk about regulatory reporting, capital constraints, settlement discipline, liquidity rules, indemnification capital costs, borrower balance sheet optimization, and how these factors affect pricing and demand. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.